Have you ever wondered why a company might build a huge factory in one country but completely ignore its neighbor? Or how investors, decide where to park their money in this crazy, volatile world? Well, a lot of the time, the answer comes down to one single, really powerful number, the country risk premium. And today, we're going to tear it apart and see exactly why it matters so much. Okay, let's just dive right in with a fantastic analogy. Honestly, the best way to think about the country risk premium, or CRP for short, is like hazard pay, but for your investment, right? A construction worker expects a little extra cash for working on a dangerous site. In the exact same way, an investor demands a higher potential payday for putting their capital on the line in a less predictable country. So here's the official definition. The CRP is that extra slice of profit an investor needs to see to get comfortable with a whole cocktail of unique risks. We're talking about risks that you just don't have back home, like surprise political chaos, new rules that trap your money, or a legal system that changes on a whim. Right, because this is not some abstract number for a university textbook. A higher country risk premium makes a company's cost of capital go up. In plain English, it just makes money more expensive for them. That higher cost then gets baked into all their financial models, and it can literally shrink the value of future profits on paper. What happens then? Well, it can stop multi-million-dollar projects dead in their tracks before a single shovel ever hits the ground. Okay, so if this number is so incredibly important, how in the world do analysts even begin to calculate it? Let's take a look at the three main tools they pull out of their toolkit when they try to put a price tag on a country's risk. These are the big three. First, you can look at the extra interest a country's government has to pay on its bonds compared to a super safe country. Second, you can measure how much its stock market bounces around, the volatility. And third, you can get a little fancy and blend the two together for a more complete picture. Each one is just a different lens to look at the same problem. But here's what you really need to get. Each method has trade-offs. The sovereign debt spread? It's simple, yeah, but it might totally miss the dangers for stock investors. Equity volatility? It's straight from the market, which is great, but it can be super misleading if not many stocks are actually being traded. And the blended approach, while it's probably the most solid, needs a lot more data. So the biggest takeaway here is that there is no single perfect answer. And this is where things get really fascinating, because there's a very common and honestly very dangerous mistake people make all the time. They use the terms country risk and sovereign risk like they're the same thing. They are not. And as you're about to see, they are critically, fundamentally different. The difference is actually pretty simple, but it is so important. Sovereign risk is narrow. It is only about whether the government itself can pay its own bills. That's it. But country risk, that's the whole shebang. It affects every single business operating in that country and covers everything from political coups to the risk that the government just decides you can't take your profits home. And the conflict in Ukraine is just a perfect, tragic, real-world example of this. Before it all started, Russia's sovereign risk was considered pretty low. The government had plenty of money to pay its debts. But then, bam, they slapped on capital controls. All of a sudden, foreign companies found their money was trapped. That was a massive country risk that the sovereign risk numbers gave absolutely no warning about. It was a huge blind spot. So let's talk about the real-world consequences here. This country risk premium, it's not just a number on a spreadsheet. It actively steers how money flows around the entire planet and basically dictates where businesses are going to invest and grow. Okay, think of a hurdle rate as the minimum profit a project has to promise before it gets a green light. So a project in, say, Canada, where there's basically no country risk premium, has a pretty low bar to clear. But now, take that exact same project, same factory, same everything, and move it to Argentina with its 9% CRP. Suddenly, that hurdle is dramatically higher. The project now has to promise a way bigger return just to even be considered. So what does that much higher hurdle rate do to the project's value on paper? Well, it can absolutely crush it. To account for all that extra risk, the future earnings are discounted way more heavily, and that can slash a project's net present value, which is just a fancy way of saying its total worth in today's money, in this case by 45%. A project that looks profitable can suddenly look completely worthless just because of the country it's located in. And for global investors, this is basically how they budget their risk. They're always trying to balance that hunt for higher returns, which are often in those riskier emerging markets, with the very real potential for huge losses. A typical portfolio might have a big chunk in safe, low CRP countries, a smaller piece in medium-risk places, and then maybe just a tiny sliver in those high-risk, high-reward frontier markets. The CRP helps them figure out those percentages. So, we've got these tools, and we've seen their impact. But And this is a really big but. It is absolutely essential to remember their limitations. The country risk premium is a powerful estimate. It's a vital tool for sure. But it is not a universal, undeniable truth written in stone.
Actually, the whole process of estimating this number is full of challenges. There's no single method everyone agrees on. Historical data, especially for newer markets, can be a total mess. And you've got to watch out for this really tricky trap called double counting, where you accidentally factor in the country's risk twice in your models, which just completely throws off your final valuation.
So, for the professionals out there, the takeaway is pretty clear. You have to be disciplined. You can't just grab one number from one source and call it a day. First, you validate it, right? Use a couple of different methods, then you qualify it. You dig into the story behind the numbers. What are the corruption levels? How stable is the government? And finally, you have to contextualize it. A giant multinational that exports everything might face way less risk than a small local shop.
And all of this leaves us with one last big thought. The country risk premium is our best attempt to quantify something that's maybe unquantifiable, to put a price on political stability, on trust, on danger itself. It's a flawed tool, yes, but it's an indispensable one for grappling with the ultimate question. If every measure of risk has its flaws, how do we ever truly know the price of danger? Thanks for joining me for this explainer.